Today, we are diving into a huge puzzle in the global economy, and that puzzle is India. See, on the surface, the numbers look absolutely incredible, but for so many investors, the reality on the ground just feels different. This is India's macro mirage, and we're going to piece it all together, starting right now. So if you're an investor in India, this question probably hits pretty close to home, right? You're seeing all these headlines about record-breaking economic growth, but then you look at your own portfolio and it's just not reflecting that same boom. It's this really frustrating disconnect, and in this explainer, we are going to get to the bottom of exactly why it's happening. You know, the best way to think about all this is like a big economic puzzle. We've got a few key pieces of data that, at first glance, just don't seem to fit together at all. But if we look at each piece carefully, one by one, we can start to build a much clearer picture of what's really going on behind the headlines. For the longest time, there was this simple, almost reliable formula for Indian stock market returns. You take about 6% real GDP growth, add another 6% for inflation, and boom, you could reasonably expect a 12% return. But now? Take a look at the new math. The GDP number is an incredible 8%, but inflation is practically zero. So that means your expected return drops all the way down to just over 8%. This completely breaks the old model, and it's our first major clue that the whole economic landscape has shifted. So let's start right there. Let's grab that first piece of the puzzle, this really weird gap between sky-high growth on one hand and rock-bottom inflation on the other. First things first, you've got to give credit where it's due. The headline number is genuinely impressive. India is reporting real GDP growth of 8.2%. I mean, that is among the fastest of any major economy in the world, and it's blown past recent expectations. On the surface, that looks fantastic. But then, you see this number. At the exact same time, headline inflation is sitting near 0.25%. An economy that's supposedly firing on all cylinders should be seeing some kind of price pressure. A number this close to zero is a huge disconnect. It just doesn't add up. So, what is this disconnect actually telling us? Well, low inflation like this is a signal that the economic growth isn't really being felt by everyone. It suggests that lower and middle income families aren't out there spending aggressively. Instead, that consumption is concentrated right at the top. And that means company growth is relying on a pretty narrow base of wealthy consumers and exports, not on strong, widespread demand from the whole country. All right, now for our second piece of the puzzle, the really troubling performance of the Indian rupee. It begs the question, right? If the economy is so strong, why is the currency so weak? This quote just captures the real-world impact perfectly. A weak currency creates what's called a silent erosion of purchasing power. What does that mean for you? It means things like foreign travel, imported goods, even gadgets that are priced globally. They all feel more and more expensive. Not because their price went up, but because the money in your pocket is simply worth less. And we are not talking about a small change here. The rupee has hit a new low of around 89 to the US dollar. That's a really significant milestone, both psychologically and, of course, financially. And listen, this isn't just a story about a strong US dollar. As you can clearly see here, the dollar has actually eased a bit against other major currencies like the euro and the pound. And yet, the rupee has continued to fall, making it Asia's worst performing currency. That tells you the weakness is probably rooted in issues specific to India. So why is it struggling so much? Well, analysts are pointing to a mix of things. You've got persistent capital flowing out of the country, not enough foreign investment coming in, a high sensitivity to U.S. policy moves, and, as we're about to see, growing concerns about the quality of the very data that's painting this rosy picture in the first place. And this brings us to our third and final clue. And honestly, it's a bit of a sensitive one. It adds this whole other layer of uncertainty to the entire economic picture, and it really helps explain why big foreign investors might be hesitating. So, the International Monetary Fund, the IMF, has recently maintained a C grade for India's national account statistics. That's it, a stark, simple letter. And it happens to be the second lowest rating in their entire data quality framework. So what on earth does a C grade mean? Well, it highlights potential issues in how the data is covered, how it's calculated, and how it gets revised later on. For big foreign institutional investors, this combination, a super high growth number next to a low data quality grade, can be a serious red flag. Uncertainty is a risk they often just choose to avoid. Okay, so we have the clues, right? We've got the GDP inflation disconnect, a really weak currency,
and now questions about the data itself. So let's put this whole puzzle together and see what it actually means for navigating the market.
This table, right here, this really gets to the heart of why your personal portfolio might be struggling, even while the main Nifty 50 index is hitting all-time highs. Just look at the divide. The large-cap Nifty 50 is doing well, valuations are reasonable, and that's where the big institutional money is flowing. Meanwhile, the small and mid-caps, which is where a lot of retail investors are concentrated, they've underperformed and have seen some pretty sharp corrections after being overvalued for a while.
And that is the punchline. In this uncertain environment, new money, both from inside India and from abroad, is playing it safe. It's flowing into the biggest, most stable, most liquid large-cap companies, and it's basically leaving the broader market behind.
So, what can an investor actually do? Well, based on all this evidence, a few strategic ideas are starting to emerge. First, diversifying into U.S. assets could be a smart hedge against that weakening rupee. Second, within India, focusing on quality large caps helps align your portfolio with where the capital is actually flowing right now. And third, practice patience. The market has been incredibly volatile, which makes it a really tough environment for hyperactive trading. Now, let's be clear, this is just an illustration, okay? It's not a specific recommendation, but it shows you what a more balanced framework could look like. You'd maintain a strong core in Indian equities for that long-term growth, but you'd also deliberately build a 20 to 30% allocation to global or US dollar assets, just to protect your purchasing power from that silent erosion we talked about earlier. So we end up right back where we started, with a really complex picture. India's economy feels a bit like a mirage right now, booming growth that seems to mask a more challenging reality underneath. The key takeaway here is that looking beyond the headlines is more critical than ever. Understanding these underlying forces is the absolute first step to navigating them. The only question left is, in a market full of mirages, how will you find reality?